Hello and welcome. When investors have to decide which stocks to buy, hold or sell, experience obviously counts, but often the final decision still comes down to instinct. As much as anything else, it's about having the courage not to give up in the face of a challenge. Now for some people, a simple pep talk might work, but fund manager Adam Rackley decided to put himself into that mindset in a very different way. He decided to jump into a small boat and row across the Atlantic from the Canary Islands to Antigua in the Caribbean. We're very pleased to welcome Adam as our guest castaway today, so stay tuned to discover how that amazing feat of endurance has affected his financial strategies. In this, episode 36 of The Desert Island Investor. This episode of the podcast is generously hosted by Progressive Equity Research. Visit their website at progressive-research.com.
I have built up the campfire and Paul has prepared his signature mango and coconut pressé, and we're delighted that our guest castaway has agreed to join us on the island today. It's Adam Rackley, who runs the SVS Dowgate Cape Wrath Focus Fund. The phrase larger than life could have been coined specifically with Adam in mind. Besides a career in investment, he has degrees in philosophy, politics and economics, finance and financial law, and has served as platoon commander with 1st Battalion Black Watch. He has also lived out in India, and he has cycled from John O'Groats to Land's End, run across England, Scotland and Wales. He has swum the English Channel and rowed across the Atlantic, which took a mere 11 weeks. He has written the book Salt, Sweat and Tears, which I've read, and this is about his journey across the Atlantic and those that preceded him. I recently found him on YouTube in a white-collar boxing bout, which unsurprisingly he won. Last year I met Adam for coffee in Llandudno, where he lives, and he was in training for the Everest Marathon. So I decided it was probably not worth bigging up to him the fact that I was climbing Snowdon the next day. However, to my credit, when it comes to grueling, physical and mentally sapping endurance activities, I can counter all Adam's achievements by stating that I've been married for 34 years. Adam has some more sedentary interests and indeed likes to make his own marmalade, so that could be quite handy as we have some orange trees here on the island. Paul and I have just helped Adam haul his rowing boat onto the beach. Welcome, Adam.
Thanks for having me, Paul, Mark. It's a lovely spot you've got here, but who finished the mango and coconut press?
Adam, we're here first and foremost to talk about investing and your fund, but we have a number of younger people who listen to the podcast who are at the start of their journeys, and you've done a number of out of the ordinary sporting activities, and I'm not suggesting these were undertaken with the purpose of look at me. But have you any sense that having things like this in your CV instead of interests such as stamp collecting, going to the cinema, or growing bonsai have piqued an interest for employers to at least take a look at you and given you an opportunity to showcase what you've got to offer professionally? And just to follow on from that, in the UK, there are around 4,700 funds all competing for coverage. And I would suspect this might draw attention people's attention towards the fund, as I must admit it did with myself in the first case.
Yeah, good question. I think from in terms of writing a CV, I don't think I've written a CV since about 2005. So, but to your point specifically, I guess about marketing, I'm sure that it does make some difference. It's something that I kind of started putting into my bio. I don't know, probably 10 years or so ago. I had a kind of financial training business at that point, and a former colleague of mine asked me to send them over my bio so they could pitch me for some business. And I sent over the bio. And the guy called me back and he said, "Adam, you've done loads of interesting stuff, but your bio is so boring." And so And so that was a point at which I kind of thought I'd try and zhuzh it up a bit. I'd always been quite kind of naive on the marketing front and always seemed completely irrelevant to me, why anyone would care what I did, in my free time when considering, working with me professionally. But I took that colleague's kind of feedback on board and tried to get a bit more savvy about how I presented myself. And so, although it's kind of not my natural inclination, I kind of do highlight all those kind of personal interests more now, and I think it does, as you pointed out, probably offer a small kind of distinguishing feature, at least to pique someone's interest.
Yeah, well, it's interesting that you've had a bit of a change of tack. Oh, just on these, these endurance activities. I'm sure there's been times when you've had to dig deep. Is this something that you can draw on as a point of reference when things are tough professionally?
Well, I think I think the two are related, but I don't think kind of one leads into the other per se. I think they're both a function of my personality. So I think my appetite for endurance sports and my appetite for a fairly kind of grueling form of investment strategy, high volatility at least, are kind of both related to my personality. And I think to have longevity as an investor or doing anything really, you've got to really love it. And I think one element of that is that it's compatible with your personality and who you are, and so hence the types of hobbies that I like and the form of investing that I like to do.
Right, well, moving on to the fund, I've had a look at the last monthly fact sheet of the SVS Cape Wrath Focus Fund. It's got 35.3 million of assets under management, and it's a very concentrated fund indeed, with just 23 holdings. Now, for shorthand, I will describe it as a recovery fund, but to do it justice, do you want to flash out the strategy?
Yeah, sure. So we describe it as a behavioral value strategy. So we are looking for situations where other investors are selling for what we believe to be emotional rather than rational reasons. So rather than selling because the risk reward kind of asymmetry isn't there, they might be selling because, for example, the types of companies we look for have often had a series of profit warnings. So it might be a quality growth fund that no longer fits that quality growth profile, and so the manager has to sell it. It might be a holding that's caused them a lot of pain, that they've had to answer a lot of awkward questions about them from their investors. And it might come to the point where emotionally it just makes more sense to get it out of the portfolio and try and forget about it. So we call these situations capitulation events. And typically a capitulation event, it might be the second or third profit warning that a company's had over a period of time, and that might be a kind of very significant leg down, marked by some notable turnover in the shareholder base. And we find those often provide us with profitable entry opportunities. Second thing that we're looking for is an opportunity for a narrative shift. So that is a catalyst, effectively a small, some pieces of news flow that we think could cause a reevaluation of the narrative around a stock and drive a re-rating. Because the way we kind of see it, the share price is a function of two things really. It's the earnings that people expect the stock to deliver, and then it's the multiple that you want to apply to those earnings. And the multiple is essentially a function of the narrative around the stock. Can we create a story whereby this is a 8 times PE company, or a story where this is a 25 times PE company? And there are always multiple narratives around a stock. There will be brokers on the sell side with their narratives. There'll be existing holders with their narratives. There might be some short sellers with their narratives, management team, and really what's determining that multiple, as we see it, is what the dominant kind of narrative is. And so, we're looking for situations where, following a capitulation event, there might be some items of news flow that would cause a stock to kind of bump from a more lowly rated narrative to a more highly rated narrative. So that's kind of how I summarize our investment strategy.
All right. Well, there's many different types of investing, and on this, what made you create a fund focusing in this way? Was it where you thought that it was down to the best returns, there was less competition in this area and room for a niche, or did it just better match your own personality?
Yeah, I think it's predominantly the kind of final point. I mean, I think that there are, as you pointed out, many different styles of investing, many different strategies, and I think the one that and I should say that those strategies, when they have a good rigorous process wrapped around them, and when that process is applied with discipline, I think there are many different forms of strategy that can work. And earlier in my career, I worked for a firm that invested in UK and European small caps with a quality growth strategy, and I think they did what they did exceedingly well, and the performance at that firm bore that out. So I've kind of worked on the quality growth side as well as the deep value side, and I can see that both work. But I think ultimately, I guess back to my previous point about having kind of longevity in this industry, you need to find a strategy that fits your personality type, and so ultimately that's what's kind of led me into this form of investing when I launched my own fund.
Yeah, I think people need to know who they are. That's I think that helps if you understand how you operate yourself. Now, while I was out in Mauritius, I read your book, Salt, Sweat and Tears, and I did enjoy it. It's a very honest book, and I passed it on to Daniel Washburn, who lives out there, and he's an analyst and one of the partners at Fundsmith and a keen sailor himself. So hopefully that copy is still on its own travels from investor to investor. Out of all the book, I've just extracted a few words from when you were preparing the boat, and you said that you were painfully susceptible to boredom. So is this still a part of your character? Has it dimmed at all with age? Have you had to learn to temper it at times? I'd say I'm a very patient investor, but at times guilty of not acting with the urgency I should have.
Yeah, I think that it's certainly something that I kind of manage. I am always, in a personal capacity, interested in new adventures, new experiences. But certainly in a professional capacity, you've got to apply some discipline to that. I think the strategy that we have by its nature has a relatively high turnover. And so we are kind of always looking for new ideas. It's kind of unlike that classic image of like a kind of Nick Train making one investment decision a year from his library. This is a much more active strategy. And I think that, I guess more broadly, I'm always thinking about ways to optimize the strategy, ways that we can do things better, and that certainly allows me to satisfy that kind of element of my personality that's always looking for something to kind of open up new neural pathways, fire up those synapses in different ways.
Well, I'm not making myself out to be Nick Train, but I'm certainly closer on the spectrum to him than probably yourself. I have a buy and hold mentality, and I actively try to be inactive. And I've stressed many times that there's different ways to be successful. Now, ahead of this podcast, I checked my own portfolio of 30 stocks, and I found out that the average holding period was 9 years and 3 months, and I've held Tesco for 20 years. So,
wow.
What is the average holding period for your fund? And within that, could you share what's been your longest holding?
So our average holding period is about 18 to 20 months.
Right.
So short of a year and a half to 2 years, basically. And it's something that we actively try to reduce, and we've done a lot of analysis, and we find that our best performance actually comes from the stocks that we have a shorter holding period for. And I think there are some kind of behavioral reasons behind that as well. But we do hold some stocks for longer. Let's see an example like Gulf Marine Services, for example. We held that one for 4 years. So that would be at the long end of our holding period. And then there are some companies that we will have held. I mean, we recently exited Ricardo, for example, having held that for about 6 weeks. So that would be at the short end. So that's the kind of range. There's a broad range, but the average would be 18 to 20 months.
Okay, that's interesting. So on time, do you ever have a holding whereby you've waited for the turnaround and you still think that it will transpire, but it's just simply taken too long and you decide to drop it from the portfolio?
Yeah, this is. I mean, we make mistakes. That's for sure. We have a investment thesis, what we think is going to happen, and we apply a time frame to that thesis. And sometimes things don't happen in the time frame that we think they're going to happen, but we don't feel the thesis is broken insofar as we still, believe that there is scope for that to happen. But the challenge really here is the difference between. I mean, what we have is effectively an anti-momentum strategy where you're kind of buying stocks after they've had a period of very bad performance, as opposed to a kind of more momentum-driven strategy. And so the key challenge for this type of strategy is value traps. Companies that you buy cheap but then just keep getting cheaper. And so the approach we take there is to make sure that we are continually reviewing our thesis to be comfortable whether it or not it still holds. And then the second thing you need to have is discipline to try to overcome your kind of commitment bias, your the sunk cost effect, and to know when actually the thesis is broken and you need to sell it, which can be a hard thing to do if you've held a stock for a while and you kind of have there's a little bit of your ego tied up in every decision that you've made, and so the discipline there is to put your hands up and say you were wrong, and it's time to move on. But we don't have a rigid. We don't use stop losses because our strategy is more typically around averaging down into positions, and we don't have a fixed holding period at which point we exit a stock. So it's more around reviewing the thesis and being comfortable whether or not it still holds, and also managing our position size based on with a focus on the risk side as well as the return side. So when we're sizing a position, we have kind of target position sizes based on the upside that we see and the risk that we attach to that upside. And so if we see a situation where the upside remains high but the risk we attach to the thesis is increasing, then that will be reflected in a smaller position size.
Right, well, your holdings have known better days, and certain circumstances have resulted in waning fortunes, and what you think you consider to be an oversold position. Now, rather than on life support, they're under critical care, and your holdings are across a range of sectors. But could you provide both a few typical reasons why the businesses find themselves temporarily distressed, and again, typical remedial action that you're looking for?
Yeah, so there are. I mean, I guess that the best examples that we look for, the most profitable examples, are situations where there is some kind of short-term one-off effect, perhaps some kind of seasonal effect or cyclical effect, that the market then extrapolates into a structural issue. If you have a company, I mean, for example, we've invested in CVS Group, the veterinary services company, a couple of times. The last time we invested, it's a current holding in the portfolio, and previous to that, we would have held it probably 7 years or so ago. I don't have the date off the top of my head, but previously when we'd invested in it, they were having some short-term issues, in part around availability of staff and wage inflation around staff, and the market had kind of extrapolated that into structurally lower margins. And when those issues passed, and it was clear that actually margins were going to carry on increasing, there was a very significant re-rating in the stock. And at the moment, CVS the sector is going through a competition, a markets authority review, a CMA review, and so that had significantly depressed the share price. It has recovered quite a lot as it's become clear that the remedies that are going to be put in place are not as severe as some people had feared. So these are kind of the temporary challenges that the market kind of extrapolates into a permanent issue, and derates accordingly. And when it becomes clear that these issues will pass, then that can drive the kind of re-rating in the stock. So that's a kind of broadly the type of situation that we look for. I mean, there's also situations, turnaround type situations that we invest in, where there have been some more significant issues with the business. New management team comes in, puts in place a turnaround plan. As Warren Buffett likes to say, most turnarounds never turn. It's always extremely challenging for management to come in, and easy to write a plan but hard to implement it. So an example, a company like NCC Group, which is an IT services business. We've invested in NCC 4 or 5 times over the last 7 years. Over that 7-year period, the shares have done effectively nothing. If you're a long-term holder in NCC Group, you would have made a few percent return over that 7-year period. But over the 4 episodes that we held the shares, we've made a cumulative return of almost 400% by buying after a period of weakness, and selling as the company re-rated with optimism around a turnaround plan that ultimately never happened and led to another profit warning, and the kind of cycle continues. So that's another kind of scenario, and I guess that kind of also speaks to our strategy, where we're obviously we have to do a lot of work on the fundamentals of the business and the company strategy, but how we're looking to make our money is not so much on the execution of that strategy, but more on the perception of other investors about that business and about the execution of that strategy. So in the case of NCC, where the turnaround never actually happened, it's still possible to make money because you're betting on the market's perception of whether the turnaround is going to happen or not. And so, whereas a quality growth investor might be looking, or is looking to make their returns from the long-term compounded earnings growth of the business, we're looking to make our returns from the re-rating that typically precedes that compounded earnings growth, or at least coincides with the perception that earnings growth is going to happen. So we're kind of taking one step removed and thinking about the other participants in the market and how we can make money from them, rather than specifically how we're going to make money from the long-term profitability of the underlying business.
That is very interesting. That's very interesting. So on the screening system, where do you start for likely candidates? Are you monitoring for which stocks have seen the steepest falls?
Yeah, we've got a number of screens that we run and a couple of other sources of new ideas, but I would say the most of our ideas come from precisely that, situations we're looking at where companies trading 60, 70, 80% down from its 3-year high. And that provides a starting point for us. Because what we're looking for as a starting point is a company that's hated by the market. And the significant share price decline can be a great indicator of that. And then the challenge that we then have is that, well, actually 80, 90% of the time the market is right. Which is why momentum is typically a winning strategy. So a company that is that has got cheaper in the past will probably continue to get cheaper in the future. And so all of the due diligence we then do is around trying to weed out the value traps and find that small handful of opportunities within that broader set of companies with share price declines that are ultimately going to be profitable.
Okay, so during market crashes and corrections, are these a good feeding ground for you when people are running around with their hair on fire and the blood's running down the walls? Because sometimes in the maelstrom, companies are written down indiscriminately.
Absolutely, yeah, that's exactly what we're looking for. I mean, either in a broad market sense or in a company specific sense, it's precisely when people become more emotional, which is typically when they're faced with high volatility, that we find these behavioral opportunities arrive. I mean, the caveat, I guess, is that when you have a broad market drawdown, there is typically a reduced risk appetite and a flight to quality. And so in those situations, the types of companies that we have in the portfolio are going to suffer bigger drawdowns than companies held by a kind of quality growth strategy. So if you look at a COVID type scenario, we are going to have a bigger drawdown than the wider market, but as the risk appetite returns, we're going to have a more significant inflection than the rest of the market.
Okay, well, on your due diligence, how quickly are you able to act? In case the recovery both in the business and the share price starts before you've been able to open a position.
So the due diligence process takes about a week of my time and a week of my colleague Anders's time. So it's kind of two man weeks. We can do to a degree. We can run our kind of processes concurrently. So it might not take kind of two kind of calendar weeks, so to speak. What we like to do is look at a company before it has the capitulation event, rather than once the capitulation has occurred. So a company might spark our interest in advance of having that final kind of significant leg down, and then we can do our research, and when that leg down happens, we can quickly update our models, review the thesis, kick the tires, and decide whether it's right to allocate. So that's the ideal scenario for us. We're kind of ready and waiting, and we've done the work in advance. And we have we have obviously, as you pointed out, the portfolio of 23 holdings at the moment. We have a longer watch list of companies where we've done the work recently, and we're ready to invest should the risk reward look right. And then we have a much longer list of companies that we've looked at in the past that we could easily update, although we're not monitoring them live, we're not updating the valuations on a regular basis. We could easily kind of refresh our view of them, and that database is a couple of hundred companies, just the companies we've kind of looked at, over the last 8-9 years or so. So that's the kind of how we try and make sure that we're ready when the opportunity arises.
Yeah, you've got a deep repository of knowledge then. It's not as though you're starting from scratch each time. Let's take a look at the positive side. When you open a position, is this with a defined minimum upside in mind? And what's your taking profits discipline? Do you sell on a predetermined price, or are you tempted to just keep running it?
Yeah, so we look for. I mean, at the moment, the weighted average upside in the portfolio as of Friday last week is 88%. So that gives you an idea of broadly what we see. And in terms of managing the portfolio, the initial position size is a function of what we see to be the risk return. So you might have a company with 100% upside, but which we see as very high risk. And that might have a smaller weighting in the portfolio than a company with only 50% upside that we perceive to be much lower risk. And then in terms of the ongoing portfolio management, it's a question of updating our target price, our assessment of approximate value, we call it, and updating the risks that we attach to that thesis, to that upside, and then managing the position size accordingly. And then we are disciplined on the exit. So we always exit at or around that fair value. You know, typically within a few percent of our assessment of fair value. But by the time we get there, it's not like we're exiting the largest position in the portfolio in one go, because it will have kind of gradually moved up to kind of 0% upside. So we'll have been kind of taking profits along the way. So by the time we exit a position, it will be usually one of the smaller holdings in the portfolio.
Okay, so you're invested across many sectors, but are there any sectors that you avoid for, might be ethical reasons, where you feel you do not have a sufficient command, or perhaps another reason?
Yeah, I mean, if there's sectors that are require kind of specialist or technical knowledge, then it's a big decision if we decide to go into them, because there's an opportunity cost. The time and the energy it's going to take to acquire that specialist or technical knowledge is going to preclude us looking at another company or another couple of companies. And that's one of the other reasons why we typically shy away from larger or more complicated businesses. So, you know, a Rolls-Royce, I mean, we have invested in Rolls-Royce in the past, as it happens, but, you know, to understand a Rolls-Royce, to get under the hood of all the different business segments, you're basically giving up the opportunity to spend that time on, you know, 3 or 4 smaller companies. So in terms of kind of specialist sectors, it's not a question necessarily of just saying, no, we won't touch these sectors, but it's a question of thinking, well, is it going to be worth the investment of time and energy to get up to speed sufficiently to make that investment. In terms of ethical factors, I know we will disagree on this, but palm oil is one sector we don't invest in, and there are other specific examples. I mean, more generally, anything where there is an element of addiction involved. So gambling, tobacco are areas where we have, you know, I personally have trouble, an ethical problem investing. And then if there's on a company specific basis, you know, if we feel that the management team is unethical, so there's an example of the legal services business, I've written about it in the past, where we didn't invest because we found some unethical kind of personal behavior on the part of the CEO and the senior management team. And actually, ultimately, the company went bust, I think, within 12 months of us kind of publishing our research on it. And another example would be, I mean, Chemring. So Chemring is a company we invested in the past. But when they started selling arms to Saudi Arabia for the war in Yemen, although we didn't have a kind of strong view on which was the right side and which was the wrong side, we could see the war was effectively causing a countrywide famine, and the kind of the cost in terms of kind of innocent lives was far too high for us to feel comfortable making money from a company that was profiting from that conflict. So we exited our position in Chemring. So I guess it's a slightly kind of idiosyncratic kind of ethical approach. We don't sign up to any of the kind of the ESG certificates or organizations. I think if you kind of hitch your kind of moral cart to somebody else's horse, then you're not really making a moral decision. You're kind of engaging in a box ticking exercise, and that completely undermines the point of having an ethical approach. So So we don't have an ESG approach per se, but I do apply my personal ethics to investments in the portfolio.
Well, that's good for you anyway. So, there's a few categories there, but a few sectors, but there's plenty of other waters in which to do your fishing. On where you invest, is the fund restricted to the UK?
Yeah, UK listed companies. That's right. So, I mean, we have the company could have its business focus outside the UK. It could be headquartered outside the UK, but it's all UK listed companies that we invest in, and that's kind of part of the in the fund prospectus essentially.
The fund was launched in October 2016, and you threw your lot in with Dowgate in August 2024. What advantages does this bring? And perhaps it's an unfair question, but I'm going to ask it anyway. Has that come at any price? For example, a loss of sovereignty or having to go down to Dowgate's offices on Fetter Lane that I have myself visited when seeing our mutual friend Jeremy McEwen?
Oh yes, Jeremy. Yeah, great guy. The biggest downside is that the name of the fund is now a bit of a mouthful. We've got Dowgate and Kate Rath in it, but more seriously, I mean, I think I mean, it's actually something that kind of. I think first time I met Jeremy, he came over to me and the first thing he said to me was, "I know what your problem is," which I immediately thought, "Oh, I like this guy." Um, and I think that often as many fund managers, particularly if you kind of a value manager, you have this kind of slightly awkward contrarian approach. You're probably naturally more of an introvert, and so I guess working in a kind of larger firm environment might not be might be a challenge. Certainly, I've always found it kind of helpful, taking myself kind of out of the throng, so to speak. So living and working in North Wales is kind of helpful. But yeah, I mean, in terms of specifics, really, it's only been advantages for us of working with Dowgate. I mean, we've got first of all, previously Anders and I were responsible for an FCA authorized firm, which for me felt like a big weight on my shoulders for my colleague Anders, who drew the short straw and who was compliance and money laundering reporting officer. There was and did all our FCA reporting. There was a lot of extra bits to worry about on top of the day job of researching and picking stocks. Now that we're working with Dowgate, we're no longer responsible for an authorized firm, and all of those regulatory responsibilities have been passed on to people much better qualified than us. From a client perspective, we now do all of our dealing through the Dowgate dealing desk, who have a huge amount of experience and expertise in the UK small cap market. There was a period when we were running the Kate Rath fund, and also we were managing a Dowgate fund on identical strategies. But the Kate Rath fund, we were dealing through the dealing service provided by our old ACD, whereas the Dowgate fund we were managing through Dowgate and executing through the Dowgate dealing desk. And over the course of a year, the performance difference, based largely on the difference in execution, was almost 200 basis points, so almost 2% performance difference to a large degree based on difference in execution. So I think from a client perspective, that's an absolutely huge and quantifiable benefit of working with Dowgate. I mean, I think in terms of the sovereignty piece you mentioned, as I said, I think we've working up in my kind of office environment hasn't changed insofar as I'm still still working up in North Wales. The strategy is unchanged. I'm still working with Anders. We still work the same way that we always have done. The fee structure is unchanged. Nothing about the kind of way that we operate has changed. So I don't feel there's been any kind of real loss of sovereignty per se. And I think it's also given our clients more comfort, not only from in terms of the kind of regulatory side, but also from a kind of operational side. We're now backed by a much larger firm, and so the operational risk, which I think is always on an allocator's mind when they're looking at a very small boutique, a lot of that operational risk has been taken away. So for us, there's been only upside really to the tie-in with Dowgate.
Well, it sounds like a win-win then. I don't know if you just use that word boutique, but is there a ceiling to what you think the fund can manage in terms of assets under management?
Yeah, so we've always spoken about a hard close at a couple hundred million. So we've got a fairly kind of focused form of value strategy, and we find opportunities across the market cap range, but predominantly in the mid and small end. And so for those reasons, for liquidity purposes, and in terms of the availability of ideas that fit our strategy, we do have a kind of ceiling of a couple hundred million in terms of what we could manage in this strategy.
Well, I look forward to you getting there anyway. So I think from what you've said, you've run the fund pretty much with a single colleague. And it's a concentrated fund consisting of companies under some distress. How much pressure is there if you're away from your screen, you're in a meeting, or there's no phone signal in the Himalayas and something that's happening that could do with acting upon?
Yeah, so I guess I'm fortunate that Anders and I have worked together on and off since probably 2008. So I mean, certainly over 15 years, probably approaching 20 years. So we have a very clear understanding of how the other one thinks, and we've developed a way of working that suits our skill sets and our personalities. And so if I one of us is always around, and if I'm away for a period of time, Anders will have I'll leave him some fairly clear kind of outline, some instructions regarding specific holdings in the portfolio and what I'm thinking about these. And beyond that, Anders, knows the strategy itself and how I execute it inside out. So he's a kind of very capable number two in the event that I'm not at my desk or not available for a period of time.
Right. Well, that's probably a similar period of time that Paul and I have known one another, and he's still got that same sense of humour, that same twinkle in his eye, and if I'm being frank, he's still got the same suit. But when choosing somebody to row the Atlantic, I would suspect among the criteria are things like physical fitness, endurance, and mental toughness. When running the fund and choosing somebody to work with in another type of intense partnership, what qualities do you think are important? I would assume that there needs to be mutual respect and a common way of thinking. But with Paul and myself on the Desertile Investor, I ask him to be brutally honest with me, and he does challenge me. And I would say that he's correct at 90% of the time.
Yeah, I think mutual respect is the biggest one. I definitely agree with that. I think in terms of common way of thinking, I mean, I think there are two ways of seeing this. I guess the first thing I would say is that Anders does. I wouldn't say he sees the world the same way that I do, and I would say that I'm certainly a bit more extreme in terms of my approach to value, in terms of like perhaps the kind of purity of my attitudes and the specific way I like to implement value, and that's kind of back to some idiosyncrasies in my personality maybe. Whereas I'd say Anders is has got a kind of broader view in terms of investment styles and investment strategies, and so he has I would say a kind of tempering effect on me, and Anders has lived and worked through a few more market cycles, so he has a kind of broader perspective than me. So I think it's not it's if you've got two people who think exactly the same way, then you've got a big risk of groupthink. And so I think actually I've found it extremely helpful having someone who thinks in a, we're aligned in terms of what we're trying to achieve. We have a lot of mutual respect. We've got a complementary skill set, but he does bring a different perspective with him, and so that's been really helpful. And I think it's also, you develop ways of working based on your respective personalities, and so we've kind of evolved how we operate based on what fits best in terms of our personalities and skill sets.
Okay, so since the inception of the fund, running parallel to this has been the trend of moving to low-cost trackers. What pressures has this brought to the fund industry, and has the fee structure changed on your fund at any point since inception?
It's brought huge pressures to the to the active management industry. You just have to look at the woes of the large active managers like a Jupiter to over the last 5 years to see that. But I think, more specifically, I think the types of funds, the types of strategies that are under pressure are those that are effectively closet trackers. So those that have a very high correlation with the benchmark. I think there'll always be an appetite for something that's genuinely active, and I think that's probably where boutique managers kind of have their day, because typically, boutique managers with more niche strategies with lower capacity are going to be those that are able to offer something genuinely differentiated. The challenge with being kind of bulge bracket firm with a mega fund is that as you grow in assets, you're less able to do anything materially different from what the benchmark is doing. In extremis, you get all the assets, you are the benchmark. So there's this kind of a scale of how active you are that is, I think, correlated to the size of the fund. And I think that the ones that have suffered most are the ones that have been the bulge bracket type funds that by nature of their size and by nature of their marketing strategies have tended towards higher correlation with the benchmark, and perhaps for the fees they charge have not offered anything materially different, and so there's been very significant fee pressure and outflows from those types of funds. But I think there'll always be scope for genuine active, and perhaps even more so when more money is going into passive, and you have a kind of barbell effect of money going into cheap or almost free passives, and then an allocation, a satellite allocation into genuine active.
All right. Well, this is the last question I've got, and I don't want to dress this up as a Columbo, where it's the most. He leaves the most difficult question to the last. But the fund charges a performance fee, and can you outline when this is applicable? And what would you say to the comment, when the fund underperforms, the investor takes the hit, and when the fund does well, both the investor and the fund manager benefit?
Yeah, that's a great question. That kind of that risk asymmetry is the principle, I think, pushback against performance fees. The old days of 2 and 20 when the fund manager made plenty of money, whatever happened. I'd say that the insurance policy that we offer our investors is that my investable net worth, my family's investable net worth, is in the fund. So if the client loses money, then I lose money as well. The way that we've set up the fee structure, I guess, back to kind of to answer your previous question as well about fee structure. So the fee structure that we launched the fund with, the principal share class, the A share class, has a 30 basis point AMC, and when we launched it back in 2016, this was effectively a tracker type fee. Today the tracker fees have continued to drop, but effectively we were pricing it so that if we performed in line with the benchmark, we got paid as a tracker. And then there's a 20% performance fee based on the higher of our performance versus the high watermark, or our performance versus the benchmark. So the high watermark is the fund NAV, or the fund price at which we last charged a performance fee. So we can't, if we have a great year, and then we have a really bad year, and we have another good year, but we don't get over that high watermark, then we're not going to charge a performance fee, irrespective of how strong our performance has been in that individual. We might have beaten the benchmark by 30% that year, but if we're not yet back over that, 150p, 170p high watermark, then we're not going to charge a performance fee. So it is a kind of proper hurdle. I think the days when a fund could charge a 2% performance fee over over a kind of LIBOR or whatever it was, without a high watermark, are kind of long gone. So it is a proper kind of hurdle that we have to surpass. We have to deliver basically positive absolute and relative outperformance to charge our fee. And effectively, the way we structured it is that if we just perform in line with the benchmark, then we don't make any money. We can keep the lights on, but we can't really kind of pay ourselves without delivering that performance. I mean, the original kind of concept for the fund was that I just wanted to set up a vehicle. I was always going to invest in this way, whether personally or professionally. And the concept behind the fund was to set up a vehicle that would allow other people to co-invest alongside me. And so the original idea was never really to make money off the investors who'd invested alongside me. It was more to make money out of the capital that I had in the fund myself. And if we had a really fantastic year, then those clients would pay a little bit of that outperformance to me. But in any normal year, what they were paying would simply pay for the operational side of the fund, and all the kind of services wrapped around running a UK kind of regulated structure. So that was really the kind of philosophy behind the inception of the fund, and that's why we have the kind of fee structure that we do.
Well, thanks for outlining that, because that's doesn't strike to me to be a contrived performance that follows underperformance. So whenever we get a castaway along, we ask them to bring a stock for the treasure chest, and I always stress that this is it's not a tip; it's just a typical company from your portfolio that we can just have a look at just for a brief, just a kick around.
Sure.
But what you did say to me is that given your holding period, it might not age very well. So Paul will have to get his skates on to get this. He might have to get his skates on to get this published. But what have you come up with? What have you brought for us, Adam?
So I brought the pub company Marston's. I mean, actually, we have held this one for about 12 months. So this has been in the portfolio for us for a reasonable amount of time. So Marston's, I'm sure most of your listeners would be familiar with their pubs. They operate just over 1,300 pubs across the UK. They also previously had a brewery business that they operated in a joint venture with Carlsberg. And part of our thesis kind of around our initial investment in Marston's is that we believed that they were likely to sell this pub business, and that actually the pub business itself was probably worth more than the whole kind of market cap of Marston's. So effectively getting the whole pub business in for free. And actually, not long after we invested, they did announce a disposal of the brewing company. And so the shares did have a kind of nice run from 27p, probably we invested up to kind of 40 odd p today. But our view is that there is still very significant upside to reach anything like fair value. So, I mean, the most recent results, they reported some interims last month. EBIT increased so operating profits were up 20%, and this was in a large part thanks to they've got a new CEO in who unusually does not have a pub background. He's come from Merlin, which runs places like Alton Towers, so he has very much a kind of customer experience background, and his focus has been on precisely that, driving kind of customer experience in the pubs. So he's got a range of new pub formats, and he's rolling out across the estate. So kind of identifying the demographic in specific areas and optimizing the format to cater for that demographic. They've rolled out digital order and pay, which again, I'm sure most of your listeners will be familiar with, where you can, if you want, order and pay at your table off an app on your phone. And what they see is a 10% jump in revenue per transaction when they offer this. It's a bit like kind of the old days of the kind of the Domino's first launched their order via your kind of app many years ago, and they saw an immediate kind of uplift in revenue per transaction when people were ordering kind of on their apps rather than over the phone. So there's very strong operating momentum. An issue historically had always been the level of debt, but debt is now under control thanks to the sale of the brewing JV. As a consequence of their strong momentum in the first half, we now have numbers in our model that are significantly ahead of the consensus numbers. So we are kind of hopeful for some strong upgrades to consensus numbers in the second half. Shares are currently around the 40 pence mark. How do you value this business? Well, you can value it in terms of earnings. You could also have a look at what the value of the pub estate is. So effectively, if you're buying Marston's, you're buying this portfolio of freehold pubs, and the portfolio of pubs is worth around 107 pence per share. So that's up 12. That was up 12% at the interims. So you can compare that 107 pence per share, which is the value of the pub estate, versus the kind of 40 odd p that the shares are currently trading at, and that kind of gives you some kind of objective or fundamental marker of what a fair value might be. Strong operating momentum in the first half, and that's carried on into the second half. So at the interims, they reported that like-for-like sales for the first 5 weeks of the second half were up over 10%. So that's a example, where we see a big difference between what any kind of objective measure of fair value would be and what the shares are currently trading at. And I think that the big issue for Marston's has been one of kind of perception, firstly around the level of debt that they had in the business, which has now been resolved, and secondly around the perception that they were a very they're kind of the kind of Midlands is their heartland, and they were kind of known for having these kind of traditional kind of old school boozers, very much focused on kind of wet led rather than food led sites, but that is now changing under the kind of new leadership, and we're seeing the kind of the revenue and margin uplift as a consequence of that. And so the key is for that changing the operations of the business to drive that kind of narrative shift, to revert the shares back towards something a bit closer to fair value.
Well, Adam, thanks for bringing that one. And for people who are doing their own research, it could be a bit more fun than some other companies out there. I'd just like to say, we've been waiting patiently for you to come on the podcast, and it's great that you've joined us. I'd just like to say, and two words that sometimes we hear every day, but really mean it. Thank you. And it's been terrific. And for people who want to find out a little bit more about the fund, where should they look?
So they can look on the Dowgate website. There's a fund section on the Dowgate website. And then there's also the kind of legacy Cape Wrath website, where we do have some other kind of non-promotional materials, more kind of thought pieces relating to value investing generally. So they could look at either of those for more information.
Terrific.
No, that was great. Thanks, Mark. Great questions. Thanks, Paul.
Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. If you have a question for Mark for our Question in a Bottle podcast, just complete the form on our website, thedesertislandinvestor.co.uk. Thanks again for listening. See you next time.